I'm Greg Hunter. Welcome to USAWatchdog.com. We have with us once again best-selling author Nomi Prins. You've heard about It Takes a Pillage. This book right here, All the President's Bankers, also climbing the bestseller ranks. All the President's Bankers. What a great book. It is a book that has more than 100 or about 100 pages of notes and sources, footnotes, things like that. A lot of work. Big book. It's about presidents going all the way back to Roosevelt, Kennedy, Nixon. Very interesting stuff. And I guess I should bring the author on. Nomi Prins, thank you for joining us today on USAWatchdog.com.
Thank you so much, Greg.
You are also a former managing director at Goldman, so you know all about the banks and money. And I just wanted to start with this move at the Swiss National Bank. What is your take on why the surprise move? I mean, Christine Lagarde came out last week and said, "Oh, they didn't tell me about it." I'm thinking, wow, whoa, you didn't tell the IMF that you were going to do surprise, which is roiling the global markets. Well, what's your take on why they did it and why they were so secretive?
Well, I think they wanted to really get ahead of the market. They were secretive because they were flexing a sort of independence muscle. I mean, they're independent to the extent that they're not part of the euro. They're connected to the euro. They were pegged to the euro. But they're independent. They want to stay that way. And surprising the market is a way to keep control or some control over a monetary policy. And that's kind of what they did. To another extent, they had been a part of Europe's QE movements. They had reduced their interest rate to negative in December, and that was a slightly surprising move. No one really expected that to happen, even though the ECB has already lowered rates to negative. So on the one hand, it's sort of playing ball. On the other hand, the Swiss franc simply has more value than the euro. And with Mario Draghi getting ready, most likely, to do a big QE next dump, in terms of policy on January 22nd, to at least announce elements of that policy on January 22nd and further increase the ECB's book of really toxic debt, the Swiss said, no, we're not going to be a part of that. We're already at negative rates. We're not going to be a part of the extension of this policy. So in a way, they're really playing this sort of 50-50 choice as to what will happen. They don't believe that QE is going to really be useful to them. Potentially to Europe, but they don't want to be a part of going down with that ship anymore.
Greg Mandarino is a guy I have on her all the time, and in the pre-interview I said, he thinks that this QE is going to drive the euro down and drive the buck up and give them cover. Are you in agreement with that the U.S. is also going to have terrible retail sales? It cratered. I mean, its economy's not good. And are you in agreement with that camp that says U.S. is going to have QE 4?
Well, the U.S. has really started QE. I mean, this policy, which is 6 years now going on 7 years old, to keep rates at zero, to have a Fed's book of $4.5 trillion. Yes, they tapered last year, but as we spoke before, the U.S. banks have been taking up some of that slack to sort of keep the value of bonds artificially inflated while the Fed sort of tapered back and allowed it to become a coordinated global effort of QE. So the ECB has been involved in QE, and now they're going through another large pass that will be announced in January of an additional QE. The Bank of Japan has its own sort of version of QE through easing its monetary policy and just injecting liquidity into a system because there is no other movement in the system to buoy it up. And that's had the effect of increasing artificially the value of markets, increasing the amount of debt on corporate book, on central bank books, and so forth, and that's going to continue. It's a bad policy, and there is no real exit plan to that policy. The reason the Fed sort of can taper is because they moved first, they moved biggest, and now QE is much more globalized, and there's $8 to $9 trillion of artificial stimulation that are going into mostly the banks for the markets from the central bank community that's being tacitly approved by the governments of these countries. So this is a coordinated bank, government, central bank move that has no real positive impact on actual economy. It is simply really free money, free liquidity, a free buyer for bad bonds and bad debt. And it is also, because of that, fueling what will be the next bubbles. And what are the next bubbles in asset bubbles and in debt bubbles that will then come down more egregiously than the last time, because it's now on the back of all this extra artificial support. It's been a bad artificial policy.
When I booked you, oil prices had crashed. And we knew it, and I said, I think it's bullish. She says, yes, last year, 14, I didn't think it was going to blow up. But this year, it's blowing up. Can you explain that comment you made that this year it's blowing up? You said that when I was trying to book you, or when I did book you?
Yeah, well, what's happening now in oil, obviously the price has decreased, but because of what I just mentioned, the cheap money elements and the searching for yield and searching for the new good, quick game from the perspective of the banking system, it's been oil, it's been gas, it's been leveraged loans to that sector. So of currently CLO or a collateralized loan obligation book, complex concoctions of loans which have replaced what were complex concoctions of mortgage and subprime going into the last crisis, we now have loans. And the biggest issuers of the CLOs and the biggest issuers of the loans, the leverage loans, disproportionately to the oil and gas industry, have been the same big banks that were at the heart of the last crisis, of course, because they have that cheap capital. Now that capital is even cheaper than it was, again, before the last crisis. So that's gone into oil and gas loans, and when prices were up, that was okay because the collateral against these loans from the oil and gas companies was payable. Money was coming in. Oil prices were higher. They were making more margin. They were making more profit. With oil prices now depressed and going down lower, they're going to default. And it's interesting because in April last year, and this is when oil prices were still up, the OCC put out a report about the danger of oil and gas loans in particular because they're growing so quickly on the books of the banks. It didn't really name the banks. It didn't dissect who got what and what the amounts were, but we know who the people are. We know the culprits. And they basically said the real problem with these loans is, obviously the codependency, the volatility in the market, and the fact that the collateral is basically backed by prices. There's nowhere else to go. You can't really sell off a lot of your equipment because it's not going to gain enough capital fast enough to make up for the fall that the price drop is creating. And so there's a deep problem. Once there's a fall, everything kind of caves in. And the other thing was last year, the Fed and other regulators in the U.S. took a look at about $780 billion of loans by the largest banks, and of course the biggest banks have the most, of which about a third they looked at and said these are poor quality loans. These have bad risk management practices. These have lax review policies. And doesn't that sound familiar from what happened in the subprime crisis? Exactly the same thing. They noticed it and did nothing. Subsequently, of course, we have the oil drops and these elements which will create more defaults and more of a knock-on negative impact on loan portfolios.
Are we going to get another financial meltdown? I mean, is it going to blow? Again,
we're in a financial meltdown. I talked with you almost 9-10 months ago about how it hadn't happened yet. It should happen because of the instability that's inherent into a system that's supported by central bank maneuvers and not anything really organic. And leveraging and finding and reaching for yield in places like oil and gas and other places on the virtue of cheap money when there's no real backup plan. And banks are just saying, hey, we got it. We got the risk now. Just like they said, we've got the risk before. We're okay. One of the major issuers of loans, Citigroup, has had its credit-based exposure, its risk exposure increased since 2008, 2009. So it's actually in a worse position from that perspective than it was before the bailouts, before the subsidization, before mega QE. The reason everything stayed intact and has for so long, and it kind of boggles the mind because this QE is epic. It's historic. I mean, it is more and larger and more insane than ever in history, and this is pan-global. But the reason that things have kind of stayed in place was because there was enough cheap money coming into the system, enough corporations getting it, of course issuing more debt on their books because it was cheap to do, but also buying their own stock and doing a lot of other things that really kept the markets artificially buoyed by virtue of this cheap money coming in. That's kind of coming to a stop. It's going to take a little bit for this year, and the reason for that is, obviously we have the negative impact of oil. However, we still have some adjustments coming in from like the last bits of this QE. The ECB QE will help provide the markets and banks some solvency for a while, and some buoy for a while. The Bank of Japan already mentioned last year it's going to continue to sort of increase its positions. That's going to work itself out through the year. So therefore, there's still a little bit coming in. The volatility is going to increase. Last year we had volatility spikes in August, in October, in December. This year we're already December, January. We're down January. So the shocks are coming in more closely, and the downsides are deeper. And so that's why we're transitioning down. So at the end of this year, you will have a lower market than we already in January have a lower market than we had in December. But it will start to come apart, and these shocks will have a more intense volatility, chaotic impact over this year, and that will basically start to unravel all of this money that's been dumped and the way in which this money has held up a system that should not be held up, that it has no inherent value.
When the Fed does institute QE, I mean, the economy's not good. I mean, enough of they keep over and over this ridiculous story, and the mainstream media keeps propelling this ridiculous story about we got a recovery. We may have one on Wall Street, and there are some bright spots with tech and flying cars and whatever. But could people dump the dollar? Could all these liquid dollar asset holders around the world? John Williams says it's plus 16 trillion. And when we start instituting QE4, aren't they, Peter Schiff says, they're going to say, oh, it didn't work. Oh, sell. Could the dollar get crushed?
The same reason the dollar didn't get crushed last year, I think is part of the reason why it will be weakened finally, because of the fact that all these sort of QE combinations are somewhat playing themselves out and there's nowhere else to go. However, the reason it stayed up and the reason it will continue, I think, to stay up for a little bit longer than those folks are saying is again, not because policy is good, not because creating so much debt on the books of the country is good, not because our GDP ratio relative to debt is good. All of those things are horrific. Using cheap money to leverage a system, horrible. Using cheap money to fix a banking system that doesn't work, not a good policy. Hasn't trickled down to the average person, hasn't helped wages, hasn't helped good jobs, hasn't helped the level of participation in the workforce in terms of looking for jobs stay up or do better. So none of that's happened. But what the dollar has going for it is this collaboration of the government and the private banks here and the Fed, and the fact that they had a first mover advantage, that the dump, that the QE, that the policies are bad, but they were first. And so what's happened is the dollar's not propped up by good economics. It's propped up artificially by all of these maneuvers, but everything else is doing so badly. And will continue to do so badly that it just has a relatively better value for now as these sort of QE moves continue to taper out, as I've mentioned. So I do think ultimately the dollar will lose that peg. But I don't really think it's going to happen this year. It may be a little weaker, but I don't think we're going to see that plunge in the very near term, because every other country is struggling right now. The global economy is weak right now. And that's why there is still an advantage to the dollar. Not again because the policy dictates that, not because this extra debt is smart. It's just on a relative basis.
Well, if the dollar gets, if the perception is the dollar is going to go down, isn't Wall Street going to front run that trade? Aren't they going to run into things like gold and art and land and whatever? Aren't they going to go into and dump the dollar at some point and start running into gold? What do you think about gold? Silver?
Yeah, yes, there is, again, this shift of the dollar going down, I believe, will be more gradual, as I mentioned, than sort of like a major, everybody dumping the dollar at the same time, because of the fact that the dollar is on a relative basis better than all of the other stuff that's going on right now. Gold will be a beneficiary of that. The reason gold, I think, hasn't, for the same reason the dollar stayed strong, is the reason that gold has done okay very recently, but hasn't had the sort of major outbreak it could have had, because, again, it's this advantage of having a bad policy, but having done it first and having done it biggest, and having other countries have the same problems or worse problems continue. So gold will increase this year also gradually, for the same reason that the dollar will not dump, but could decrease gradually as QE and all these maneuvers play out. I don't think this is going to be really that breakout year. It's going to be a year where the markets are going to go down because of the end of all this artificial aid. But we also have been underestimating the amount of aid that gets continually dumped into the markets and into these banks. And that's where, the timing is critical to look at. So yes, I believe these things will happen, but I believe the timing is a little bit more gradual. So we're going to have a lot of volatility. There's going to be a negative market. There's going to be a downward impact on the dollar. There's going to be an upward impact on gold. All of that will happen. I just think that for it being, it's not going to be as huge this year. It's going to be more of a gradual working into that over this year.
What happens if we have the black swan of war? I mean, the things in Eastern Europe, ugly. Russia cut off the gas, go through their pipelines, and they say, hey, the Ukrainians are stealing our gas. We're cutting it off and rerouting it through Turkey. And, boom, in January, holy smokes, UCB is already weak. Lawrence Kolikoff, the renowned economist from Boston University, said, they're going to be bank runs. They're going to be bank runs. What do you say about that?
Yeah, all of that's going to add to the downside and to the volatility in this market. And that's going to continue the same way it's going to continue to default oil and gas loans with the banking system here and in other countries, and in other countries and their banks which have extended into these markets, which are and have been financing pipelines that aren't going to happen, and all sorts, or that are going to happen more slowly. All of that is going to impact and will create more volatility this year and will create a negative impact this year. And the adjustments that central banks and governments have made that have kept this sort of game going, they will have less to do. It will taper out. The shocks will be harder, and the negative impacts will be harder. But there will still be some fight back from this collaboration of central banks and governments that have been able to prop this thing up artificially so long. There's just no reason that we've had 6 years of this artificial, market and growth. It's really been based on a very flawed policy. But it's like we can't underestimate the insanity of the people running these policies to continue to throw more, I won't even say good money, but more, printed money after bad printed money. I think there's going to be a balance. It's going to be negative. It's going to be negative on volatility. The shocks are going to be felt. The oil sector is going to feel them. The general currency sides are going to, the European markets are going to continue to deteriorate economically. But again, we're going to see that volatility impact and a gradual decline, and really dumb moves, really dumb prop moves, continuing to come in. I would not be surprised, for example, the Fed came in with some weird, cross-currency swap type of QE, that's sort of more on a relative basis with other central banks, if things start to deteriorate more quickly than they want it to in Europe and so forth. So I think we can see other measures come in, and that will sort of counterbalance what will still be a high volatility, negative set of conditions.
A great quote, can't underestimate the insanity. And I think a lot of big people underestimated the insanity, how insane, how criminal. I mean, a lot of big people thought this would have crashed along. I mean, you said we should have crashed. It should have crashed already.
Yeah.
But but what a great point. You can't underestimate the insanity of the people who are printing this money.
Right. And the fact that they have the ability to do it. I mean, there's no sort of external mechanism that says, wait a minute, what are you doing? Like, how are you going to get out of $4.5 trillion of debt on the Fed's book that has actually been corresponding to that same portion, equivalent to a quarter of U.S. GDP, and higher equivalencies of GDP in Europe and in Japan. I mean, there's no outside force. As people like us saying this is ridiculous. How do you put that genie back in the bottle? You can't. It's just going to create pain, and they're trying to just sort of push or kick that can down the road, and it's been ridiculously effective, but it's still not good policy.
Well, ridiculous effective until the patient dies.
Yeah, effective for the financial system, effective for the banks that haven't gone bankrupt, the largest banks. But we also have the situation where Europe and the U.S. and so forth had to basically pick 30 banks in the world that were globally systemically important and pretend that they have enough capital and enough reserves to withstand these major shocks without even, for example, the Fed didn't even count the oil shock as a shock in its stress test, nor did the ECB. So they don't really talk about real shocks, and yet they have these banks that control nearly half of the deposits and assets in the world. 30 banks, and in the U.S. the banks have that significant control, and so all of this insanity really enforces that influence and that control of a very flawed, very dangerous, very top-heavy in terms of risk system.
Well, after listening to you talk, Nomi Prins, there's no wonder why you write a book like this with 100 pages of footnotes. Very interesting, very unusual things in the book. Wow, I didn't know that about your books. All the President's Bankers. It's climbing the best-selling world. All the President's Bankers. There'll be a link for this book at the end of this interview. Nomi Prins, Thanks for coming on and giving us your analysis about what's going on in the world. Thank you very much, ma'am.
Thank you.